Now let's turn to a related psychological argument with respect to the unhampered market economy, and this is the argument that's found in survey history books of American history, a psychological explanation of the Great Depression. And the argument runs like this: that the 1920s was a wonderful time of sustainable economic progress that could have gone on forever. Unfortunately, investors became pessimistic, and their pessimism, as they sold out of the stock market, created a stock crash. And as the stock market crashed, it creates a wealth effect, reducing people's wealth. And as they become poor, they reduce their expenditures. The reduced spending then causes profitability to decline and businesses to lay off workers. And so we get unemployment as a result of reduced total spending. And as unemployment proceeds, this creates further cuts in spending because the workers without a social safety net have no income. And so their spending is cut. And as their spending is cut, this causes further distress on businesses who cut production and lay off more workers, and we get a downward spiral of the economy. Now, the economy only came out of the Great Depression, according to this explanation, through the government spending on World War II. So now let's examine the economic theoretical response to this psychological explanation of the Great Depression. First of all, we might ask the question, why exactly would pessimism arise? What exactly is the cause of the general pessimism throughout the economy of people? Why is it the case that even if some people start to become pessimistic, that this spread then to people generally throughout the economy? If the economy was doing well in the 1920s and optimism was riding high, why does pessimism arise out of this set of circumstances? It isn't made clear. This is especially perplexing since the optimism of the 1920s could easily be connected with the empirical evidence of the central bank's monetary inflation and credit expansion. This can continue regardless of people's attitudes, and if this is what's fueling the optimism, it's difficult to see why it would ever reverse, or once it reverses among some people, why it would spread to a general pessimistic view. But that's not really the main difficulty. The main point about pessimism and optimism that we spoke about in our discussion of the stock market was that markets always balance pessimism and optimism. Even if it were true that suddenly a large group of investors became pessimistic in 1929, as they begin to sell out of the stock market, their additional desire to sell is exactly matched by other investors who are buying shares of stock in exactly the same amount, who are optimistic about the future. And as the price of stock declines, it increases the optimism on the part of investors who think they're buying at bargain prices that will be easily realized in the future. So it's difficult, again, to see why pessimism spreads in markets, since there's always, in fact, a balance between pessimism and optimism. Another question about this explanation would be, were the 1920s really sustainable? If we look at the annualized return in the Dow Jones Industrial Average from April of 1924 to October of 1929, the annualized return in the Dow was 30%. Compare this to the annualized return in the Dow over the entire 20th century and the 12 years of the 21st century, the annualized return is 5%. So is it really reasonable to think that a 6 times as large annualized return in the Dow is really sustainable? Perhaps it's just that investors began to understand in 1929 that these increases in the stock market could not be sustained. Even in periods of fairly rapid economic progress like the 1950s and early 1960s, the annualized return in the Dow was only 12%. In the 1980s and through the 1990s, again, another period of substantial economic progress, in the American economy, the annualized return in the Dow was half the return in the Roaring '20s. To find a period of where the annualized return was approaching this 30% rate in the 1920s, you have to go to the boom of the late 1990s. There, the annualized return from January 95 to January 2000 was 25%. And we know also that this period, like the Roaring '20s, was not sustainable, but was followed by a significant stock market crash. It's also true that stock market declines of 50%, which was the initial decline in the Dow in October and November of 1929, were not uncommon. The Dow Jones Industrial Average fell roughly 50% in the time of the Panic of 1907. The Dow also fell 50% in the recession of 1921. There were certainly investors still alive trading in the markets in 1929 who had been through this earlier period just 8 years before, and were well aware that the Dow could and had in the past fallen 50%, but of course no Great Depression followed either of these earlier 50% declines in the stock market. Even the one-day declines in the Dow Jones Industrial Average have been bigger than the one-day declines in October of 1929. The Dow fell 13% on October 28th, 1929, and 12% the next day on October 29th. But in 1987, the Dow fell 10% in the 3 days before the Black Monday stock market crash on October 19th, and on that day, the Dow had its biggest fall in its history of 23%. And once again, no Great Depression followed these declines in 1987. It's even true that the overall decline of the Dow Jones Industrial Average is not unprecedented in the Great Depression, the decline from 1929 to 1932. There was an 89% fall in the Dow between October of 29 and June of 1932. But there was a 78% fall in NASDAQ during the dot-com bust, starting in March of 2000 and running through October of 2002. The NASDAQ, in fact, has a bigger market capitalization than the Dow having only 30 firms, as we spoke about in our stock market discussion, the NASDAQ covering 3,200 firms traded on the NASDAQ. The Nikkei in Japan fell 82% in its slide after the initial crash in December of 1989. And once again, no Great Depression followed the dot-com bust, and there was not a Great Depression in Japan. One last point about the pessimism argument to explain the Great Depression. The pessimism of investors reversed early in 1930. There was a 48% decline in the Dow from October 1929 to the end of November 1929. But from November 1929 to April of 1930, the Dow increased 43%. So it wasn't this snowballing effect that's claimed in this historical argument. Quite the contrary, investors came roaring back. in the early part of 1930, just to see their anticipations of the quick restoration of normalcy in the economy, which had occurred in 1920-21, to be dashed by the interventions of Hoover and then Roosevelt. This is what the Dow Jones Industrial Average looked like from 1920 to 1940. You can see the big buildup after 1924 to the peak of the Dow at 381 in October of 1929, the 50% decline to November, and then the rebound that we just mentioned running into April of 1930. And then as you trace the Dow moving through 1930, 31, 32 to its eventual bottom at 41.22, you can see that it continued this pattern of falling, and then investors coming back into the market and pushing it back up, and then falling, and then rising again, and then falling and rising again. So there wasn't this monolithic snowballing effect of overwhelming pessimism spreading and spreading. Investors keep coming back into the market and driving it up after another round of it declining. Again, this is the effect of their continuing reassessment of their expectations in the face of ever increasing and unpredictable government intervention that's taking place under Hoover. We can also see that the Dow increased very dramatically from the bottom in mid-1932 to its peak in 1937, increasing fivefold in that time. And from 1933, where you can see early in the year it hits 50.16, it corrects back down. This is the period in which Roosevelt takes the United States off the gold standard and unleashes a tremendous monetary inflation on the part of the Federal Reserve, which is responsible for the boosting of the stock market from 50 to 200, the fourfold increase. The market then corrects again, falls 50%, from 200 nearly to 90.95 in 1937. The unemployment rate worsens again from around 14% to almost 20%, and the market does not recover these elevated levels pushed up by monetary policy for the rest of the decade. Now here's the Dow for 1940 through 1960, and we can see that World War II did not bring the economy back to a normalcy, bring the stock market as an indicator of capital accumulation back to its normal economic progress. The market collapsed again from its high of 200 nearly in 1937 to 92.92 in the early part of 1942. We're now into the United States active participation in the war, and we see then that the Dow begins to move back up. The reason for this downturn and then increase is that the American economy was in transition between peacetime economy and wartime. So in the peacetime economy, even not fully allocated according to economizing principles in the 1930s, was still a functioning market economy where the capital stock was being brought forth by design to best satisfy consumer preferences. And then the war transition, of course, destroys the profitability of those production processes. The government seizing factories, forcing their retooling, having massive shifts of the labor force, the drafting of millions of young men into the armed forces and their replacement with untrained workers. And so we get this decline in the capital value of the capital stock Once the adjustment is made and the capital capacity is adjusted for wartime production, some wartime profitability returns. But we can see again from the movement of the Dow from the middle part of the 1940s till around 1950, that there needed to be, and everyone knew this, a transition back to peacetime, which again meant a period where the normal process of capital accumulation would take some time to restore. And we see this then in the mid 1949, where the Dow begins to move up, as we said before, at about a 12% annualized rate from 1950 to the mid 1960s. Now let's examine another claim that booms and busts are inherent to the unhampered market economy, and this is a claim of market failure, in particular that prices and wages are sticky. And so when there's an increase in spending, prices and wages do not adjust, and it creates disruptions in the economy, and therefore the boom-bust process. In particular, increased spending would drive up output prices, but not input prices. The input prices are sticky, wages and materials, goods, prices, and so on are sticky. And so as spending drives up output prices, profitability increases, the price spreads increase, and entrepreneurs are able to earn this extra profit by ramping up production, increase employment, and so on. Decreased spending then drives down output prices, but if input prices again are sticky, then input prices don't fall commensurately. Price spreads are diminished, and businessmen respond to this by lowering production and laying off workers, and we run into the bust. Now, the response of economic theory to the claim of sticky prices and wages, the first point is that the stickiness of prices and wages is actually chosen by entrepreneurs to satisfy people's preferences. Consumers have certain preferences in different lines of production for different degrees of price rigidity. Sometimes price rigidity is desired on the part of consumers for the purposes of planning, or perhaps they simply are resistant to day-to-day changes in prices. They feel they're being taken advantage of if prices move up and down too rapidly. And so entrepreneurs will accommodate consumer preferences in this respect by holding the line on prices and absorbing the day-to-day movements in the quantities purchased, still obtaining what they consider to be the average revenues, average daily revenues over time. The same thing is true for producers. Entrepreneurs might engage in a certain degree of stickiness on the part of wages, for example, simply because workers prefer this. They prefer fixed wages. They prefer to know in contract over a year's time that their wages will be set at this particular level, that they'll have these particular benefits. They don't want the wages to move up and down every day as they would in other conditions, in other markets where there might be workers who desire their wages to move up and down more readily with changes in demands for the products. So stickiness is not a technical feature of the world, but a choice on the part of the entrepreneurs, producers, and consumers. So if stickiness becomes a problem, then the parties involved can simply alter their choices and choose to make prices and wages less sticky. Also, entrepreneurs anticipate market clearing prices, and so there isn't any particular problem in the unhampered market economy with entrepreneurs through anticipations seeing what the future price arrays of their output and producer goods that they're buying as inputs will happen to be. if entrepreneurs anticipate that their output prices will rise 10% next year, they'll be bidding more heavily right now for inputs, bidding their prices up. And the inputs will rise commensurately with output price rises, and there won't be perhaps any additional profit forthcoming. In a similar fashion, if entrepreneurs anticipate a decline in output, they'll lower their demands for the factors of production today. And this will lower input prices today and restore the price spreads between output and input, or at least moderate these price spreads and hence the production effects. And then finally, even if some producer goods prices are sticky for whatever reason, this just means that capital values of specific assets will adjust instead. So if wages are in fact sticky in markets, then when output prices go up or output prices go down because of increased demand or decreased demand, then the capital value of specific assets will move up in the first case and down in the second case to adjust. And by doing so, the input costs will adjust in a way that's commensurate with the changes in prices for output. As an aside, we might note that if government intervention is what's causing wages to be sticky, for example, this just moves the volatility of input prices to capital. And so a policy of keeping wages relatively constant through legal means makes prices for capital goods more volatile, but it doesn't eliminate this volatility. Another claim that business cycles are inherent to the unhampered market economy is based on inadequate spending as a market failure. And here the argument goes as follows. In the past, productive capacity and certain levels of employment have been built up in a pattern that's sustained by total spending. And then when total spending changes, if there's a decline in total spending, this of necessity leaves excess capacity and unemployment. The physical production processes can't be changed to accommodate these shifts in total spending. We still have the factories and the trained employees and so on, and if total spending falls, it leaves the economy with resources that can't be used. Now, the response to this claim of inadequate spending, first of all, this treats the economy in a sense as a single enterprise that has a certain capital capacity, a certain workforce. And of course, it is true that if spending goes up for the output of this single firm, that this would reduce any excess capacity that it has, and it would increase employment. People would be working time and a half and so on. And if the demand for the output of this single enterprise were to decline, that it would leave at least temporarily excess capacity and employment would fall. But as we've seen, the economy is made up of a vast array of different production processes under the oversight of different entrepreneurs, all harmoniously put together for the satisfaction of consumer preferences in all the different lines of production. And so it isn't helpful to think of the entire economy metaphorically as a single enterprise. We've dealt already with the arguments about total spending. They're treating the economy as a capital structure. Additionally, entrepreneurial foresight, as we've mentioned before, can anticipate shifts of preferences. So if it's true that there's a shift of preferences toward one good and away from other goods, entrepreneurs can anticipate this. Or if there's a shift away from consumption and toward saving and investing, again, entrepreneurs can anticipate this and smoothly bring about changes in resource allocation and capital investment to accommodate the decreased production on lower stage production processes and increase production on higher stage production processes. Even if there's a shift on the part of people toward holding more money, as we've talked about already, entrepreneurs can anticipate this and perceive that the prices of both outputs and inputs will be lower in the future, and adjust demands and their selling prices accordingly. And last, the viability of production processes, as we pointed out, depends not upon total spending, but upon price spread. So it doesn't really matter for even for a single enterprise whether or not total spending on its output goes up or down or stays the same. The enterprise is viable, profitable, as long as there's a price spread between output prices and input prices. And unless, again, this is a business fluctuation where one entrepreneur is simply expressing inferior foresight by bringing to market goods that people don't prefer, and therefore has to shrink production and perhaps even go out of business, lower total spending on some lines of production will not necessarily lead to adverse production effects. If entrepreneurs anticipate this, then price spreads can be maintained as the entrepreneurs lower their demands for the inputs. And even if there are some input prices that don't adjust downward fully to accommodate the decline in output prices, the capital value of the specialized capital goods in this industry will adjust downward. And it's true that there wouldn't be any long-term investment then in this in capital capacity in these businesses, but they would be profitable to run in the interim. Now finally, let's talk about the market failure of price deflation. And again, not in the sense that we've been talking about it in the previous arguments, but in this particular claim, that falling prices increase expectations of more falling prices, which reduce demands, which decrease prices even further, which fuel more expectations of further declines in prices, and we get this downward spiral, a kind of self-fulfilling prophecy of expectations. So the argument is the market fails to accommodate or adjust production to this kind of phenomena. Now the response to this claim is, first of all, that goods still have usefulness. So demand for these goods is not delayed indefinitely, even if consumers anticipate that prices will fall. They will, in fact, eventually buy the goods so that they can obtain the satisfaction of their preferences from purchasing these goods. Most people know that prices of electronic goods continue to fall year after year, but they do in fact buy these goods, even knowing that the next year their prices will be lower and their quality will be improved. To put this more generally, prices do have market clearing levels, and entrepreneurs are in business because they're able to anticipate what these market clearing levels are and ask prices at these levels. So there is no self-fulfilling prophecy. There are simply market clearing levels of prices to be anticipated by entrepreneurs. How many units of goods will be purchased by consumers at what prices, given their preferences for things. Second point is that speculation, of course, by the entrepreneurs is rewarded for being accurate. So once again, there isn't any reason to think there's any self-reinforcing process. If market clearing prices are existent, if there are prices in markets, then entrepreneurs will be rewarded for accurate speculation with respect to anticipating these prices. There's no self-reinforcing process here. There's just the normal process of the market of entrepreneurial anticipations. Okay, in the next lecture we will talk about money and banking on the unhampered market economy.